At Option Genius, we believe that you deserve freedom, financial freedom, so that you have no more worries and more than enough money. Time freedom, so that you could do what you want, when you want to do it. And choice freedom, to live your life on your terms. But the system and Wall Street are rigged against us little guys. So how do we fight back? Well, my friend, that's what this podcast is all about. My name is Alan Sama, and this is the Option Genius Podcast.
Hey there, passive trader. I have a question for you. If I were to ask you what your largest expense is, what would you say? What is the one thing that costs you the most money? Is it your mortgage, student loan payments, car payments, credit card, health insurance? What is it? Well, if you saw the title of this episode, you probably guessed that I'm talking about taxes. And I mean, you can name them, right? With all the different types of taxes that we pay, it adds up. We got income taxes for federal and for state. We got payroll taxes. We got property taxes. We got estate taxes. We got gift taxes. We got sales taxes. On and on. There's a lot more that I can't even think of. I mean, it is estimated that most Americans pay somewhere close to 50% of their earnings on taxes. Now, I'm guessing that if you're the one that pays the bills, that's not shocking to you. I mean, maybe the 50% is kind of like eye-opening, like, really? Is it that much? Yeah, unfortunately, it really is. But in this episode, I wanted to talk about taxes and options, and one simple change that you can make to lower the taxes on your trading gains. Now, let me start off with a disclaimer. I am not an accountant. I am not a CPA, not a professional on taxes, nor do I want to be. So make sure that you talk to your tax person about anything that you hear. All right? Now, when it comes to federal income taxes, there are two types that deal with options trading. Now, here we're talking about, your gains on your trading. So if you're making gains, there's two types of taxes that you could pay. The first is regular income taxes, and the second is capital gains taxes. So capital gains is normally the tax that you pay when you have held an asset for a year or more, and then you sell it for a profit. You would pay capital gains tax on any of the profit. So if you have a stock and you've owned it for over a year, when you sell it, that's the tax that you would pay, capital gains. Compare that to if you held the asset for less than 1 year, then you would be taxed at your regular income tax rate, whatever that is. Now, capital gains is usually much lower as a percentage. Okay. Now, I don't want to go into the actual percentages here because they keep changing depending on who's in the White House and all that, the politics. But for our purposes, capital gains is lower and is preferred because, of course, it's less. So, of course, the best way to deal with taxes is to not have them at all, to not have to pay them at all. And those of you who are trading in your Roth accounts will never have to pay taxes on the gains. So if you can, that would be preferable to trade your options in your IRA so that any taxes that you have will not be taxed. You don't ever have to pay taxes on those. So that's really a cool deal. Now, if you have a regular IRA, you will have to pay taxes when you eventually withdraw the money, but you don't have to pay it now. And if you're trading in a regular trading account, then yes, you will have to pay the taxes depending on your tax situation, quarterly or yearly. Okay? Now, there is a piece of the tax code that most traders don't know about that actually helps options traders pay less taxes. It's called Section 1256 of the IRS code. Now, securities regarded as 1256 investments include non-equity options, foreign currency contracts, regulated futures contracts, dealer equity options, and dealer securities futures contracts. Okay, so now what's the difference between Section 1256 and non-Section 1256? Well, every Section 1256 security, if you have a gain or a loss, it is treated as being 60% long-term and 40% short-term, no matter how long you own it. Now, long-term means that your capital gains tax rate. Okay, and the 40% short-term means your personal income tax rate. So, for an example, if we have a Joe Schmo trader, he makes $1,000 on an options trade. Okay, and if this was a Section 1256 security option, then his capital gains tax is 15%, let's just guess, and his personal tax rate is 22%. Okay, for this example. Now, he made $1,000 on his trade, right? So 60% of that would be long term, 40% of that would be short term. So long term, he would be paying $90 for taxes, and short term, he would be paying $88 for taxes. So for a total gain or a total tax of $178 on his $1,000 gain. Okay, so he's paying about 17.8% total on $1,000. But if this was a non-1256 options trade, and he still made the same $1,000, he would be paying 22% in taxes, which is his personal return rate, and he would be paying $220. So he would have saved $42, which doesn't sound like a lot, but that's just one trade. You got to add it up. But if you look at a percentage, it's 4.2%. So he actually kept 4.2% more money in his pocket because he's trading 1256 options instead of non 1256 options. So just by simply switching, you can save or you can keep about 4% more than you already do. This is money that you've already made, but you didn't have to pay the government, right? So if you trade for a whole year, let's say, and you make 10% for the year, well, a big chunk of that goes to taxes. This way, you're actually saving 4% of that, of the total that you would pay. So instead of paying maybe, 22%, you're paying 17%. Or it could be less depending on your personal situation. Or it could be more. Most of the larger traders that we have in our movement, in our coaching programs and whatnot, they're usually trading with a lot more money. And so the percentage might be the same or it might be more because their income tax rates are different or probably higher, right? So their tax rates will vary. That amount will be more, but the dollar amount increases significantly when it's non-1256. So now that you know what that is, now that you know what the benefit is, how do you make the switch, right? How do you go from 1256 to from non-1256 to 1256? And how do you know which options are which? Well, most stock options are non-1256. And by most, I mean the options in any company that you trade or any ETF that you trade. So if you're trading Apple options, IBM options, Microsoft, whatever company option that you're trading is going to be non-1256. ETFs are also non-56. So if you go into the GLD, the USO, the IBB, any of those ETFs are non-56. And you'll know by looking at the name of it when you're going to trade it. If it says ETF, it's non-1256. Okay. The main ones that get the 1256 treatment are indexes and futures options. This is one of the reasons that I have moved a large portion of my trading funds over to my futures options trading account. Because when you trade in size, the savings are enormous. So I've been moving more and more money over to my futures options trading account so that I can pay less on taxes, even if I'm making the same amount of money. So I do have a special announcement on that. if you are interested in futures options and the way I trade them and what I do, we're having a 1-day live event called Futures Options Live this month on July 30th. It's a 1-day event. It's going to be live. It's going to be a lot of fun. You can get your tickets today at www.futuresoptionslive.com. And if you're listening to this episode close to when we publish it, there should still be tickets left. If not, maybe you can, if you're still interested, maybe you can email us, and if we have the recordings for sale or available, we'll let you know. At the live event, I'm going to be going over exactly how futures options work, how they're different from stock options. Taxes are just one of the many benefits that they have, and how you can get started with them. Okay, so hopefully I'll see you there. Now, the other kinds of 1256 options that I mentioned, the ones that I trade, are also, they're called index options. So these are cash settled options on the actual indexes, like the S&P 500, the Russell 2000, the NASDAQ 100, and others. These also get the 60/40 tax treatment. Okay, so if you're a member of our Option Genius Advisory, you'll notice that we trade SPX and we trade RUT every month. Those are indexes. Those are, SPX is for the S&P 500, and the RUT, the RUT, is for the Russell 2000. You can trade those with ETFs, but the indexes have much greater benefits, taxes being one of them. And so you'll notice that any hedge fund that is doing, say, iron condors on the S&P 500, or they're trading the Russell or the NASDAQ or whatever, if they're trading options, if they're a large trader, if they're a hedge fund, if they're a money management fund, if they're Warren Buffett, they all trade the indexes. Tax treatment is one of the benefits. Okay. The other benefit I mentioned is that they're cash settled, meaning there's no early assignment. That can be a big one depending on how much you're trading and what you want with your strategy. There are also many other benefits that we are going to cover in a future episode, so stay tuned for that. So let's say right now, if you are trading SPY, if you're trading IWM, if you're trading QQQ, if you're already trading these are ETFs. They don't give you the 1256 tax treatment. So you can do the same trade in an index and immediately start saving on your taxes. Okay. Now, the index options, the S&P or the SPX, the RUT, those are obviously much larger than the ETFs. And so it helps if you have a little bit larger account. But most traders can make the switch today. You do have to get approved by your broker. So you do have to have a higher level, or the highest level that they allow. But if you have a track record, that shouldn't be a big problem. You can let them know that, hey, I'm becoming more sophisticated. I want to try these indexes. I want to get the tax treatment. I look at my trading history. I know I can do this. And they should allow you to trade indexes. It's not much of a big difference. Okay. Now, again, there are many other benefits to indexes over ETFs. We'll cover those in a future episode. But as you saw in our simple example with Joe Schmo Trader, right? Trader example, just by switching to 1256 options instantly helped the guy make 4% greater returns. And like I said, the larger you trade, the more you're going to save. And this is like free money. I mean, it's if you don't know about it, you're going to pay it, right? If you don't know about 1256, you're just going to be paying the money in taxes, and you're never even going to think about it, never even notice that, oh my God, I'm paying too much. Unfortunately, most CPAs don't know about this. They have no clue what 1256 is, because most of their clients are not options traders. So you might have to go to your accountant, your CPA, and educate them. And you might have to tell them, hey, these options are 1256 options, and they're not regular options, so they need to be taxed differently. Now, it does mean more work for your accountant, so they're not going to be very happy about that. Truth be told, they might try to take some shortcuts and group them all together. So you have to be very on top of it. And that's why I'm doing this episode, so you can realize that there is a difference. And if you're trading futures options, then it's a little bit easier because you will get a separate tax paper for any futures that you trade. Futures contracts themselves are 1256, as well as futures options. Okay, now mostly all the time I'm only trading the futures options, not the futures themselves, because there's differences. But if you trade futures or futures options, you will get a separate tax paper at the end of the year that pretty much, it says it out. These are futures, these are 1256, so that's easier for your broker. But if you are mixing SPX and SPY trades in your regular trading account, you're going to have to separate those and make sure you tell your broker or your CPA what the difference is and how it's going. Okay, because they might not always catch it, they might not know about it, so you have to let them know. I hope that this saves you some money, and I hope to see you at Futures Options Live, the live event that we're having on the 30th. All right, have a great day, trade with the odds in your favor, and we'll talk to you next time.
Are you ready to get started with passive trading and be a consistent and confident and profitable trader, generating cash flow consistently from the stock market? Well, I have some great news for you. For a limited time, we are offering my new book, Passive Trading, for free. All you got to do is go to passivetrading.com/free book, and we will send you the book in the mail for free, as long as you cover the postage and handling. So if you can cover that, we'll send you the book for free. We've already printed it. We got it for you. We're going to send it out to you. It's free. All you got to do is just go to passivetrading.com/free book and learn the basics of passive trading. Get the behind the scenes, get some examples, learn the strategies, and put this stuff to work in your life right now. Remember, go to passivetrading.com/free book and get yours now while this offer is still available.